Good day and welcome to another GemCap Academy. It's my pleasure today to welcome someone I've known probably a good 10 years now, I think. Steve Dyson, the founder of Investment and Wealth Management Consultants. Steve founded this in 2012 and has just been telling me before we started recording here that he's in the top 100 of influential people in the marketplace. I dream of that sort of thing, Steve. So congratulations on that. How are you today?
Yeah, very, very well, Stuart, and thanks for the invite to come to the sort of the fireside chat. And obviously, my background is in wealth management. So the topic that we've decided to talk about is wealth management, how that sort of interlays through the market, how that sort of, I guess, aligns with what the sort of investment, asset management and fund management community are doing, and sort of try and set the scene of exactly how that marketplace functions. How it looks at obviously what it's looking to do. There are quite a few challenges in our environment at the moment, so hopefully we can have a very interesting chat.
Yeah, well, you're a busy man. I see you on LinkedIn, and you're very much involved in the whole area of wealth management. And last year was a particularly active year, I know, generally across the industry. And this year has continued at a pace. I mean, can we just give some numbers and some figures around the wealth management landscape in the UK at the moment?
Yeah, so again, with numbers, you can sort of put them any way you would like. It's estimated, and I've got lots of estimate, that the investable assets in the UK market is about £2.6 trillion. Oh. So that's a big figure. And then obviously that's segmented through affluent, retail, high net worth, etc., etc. So, you know, we look at it very much from a segmentation environment with the IFA community. So these are our independent financial advisors. They've got about, we estimate, an 18% market share. So the IFA market directing investments for clients they're either doing financial planning for or investments for is quite a large amount. The DFM, and again, we shouldn't talk in acronyms, discretionary fund management solutions, etc. So the traditional wealth managers offering that discretionary advisory, and now more importantly, that sort of vertically integrated model where they're also offering financial advice. That equates to about 26% of that marketplace. So it's a very, very large piece. About 670 billion sterling is within that DFM environment. And again, that will move through the segments. Some of it may be targeted at sort of the affluent, then the sort of the high net worth and ultra high net worth. So you have firms that are moving from the sort of the Ruffers, the Wavertons, through Cazenove, all the way up to sort of the larger global players. The family offices, global, what I would call the global players, BNP Paribas, SocGen, etc., they've got about 10% market share. And this is traditionally looking at the ultra high net worth environment, $20 million plus. Obviously, a lot of concierge services, poodle walking, whatever you may want to do. It's like a slightly different environment.
I've got this vision now of DFM's poodle walking.
Well, absolutely, yeah. You've got to walk that poodle to make sure you've got the right concierge services. I guess retail banks, and this is always the way with our retail banks, Barclays, Lloyds, etc., coming in and out of advice historically. Obviously, with Retail Distribution Review, we'll remember that back in 2012, where advice seemed to be something that perhaps the banks weren't very interested in, highly regulated. But we see them coming back in now. So again, we reckon that the retail banks is about 11% of market share there. And then the D2C platforms, which have obviously become more prevalent with online access, our Hargreaves, Interactive Investor, AJ Bell. And there are, of course, others that will provide that service, about 10%. And then there is what we call the residue, which is about 25%, which would be in NS&I products, premium bonds, occupational pensions, and also cash ISAs. So there is still some rump of that is most probably not going into the investment funnel. So I guess they're the size of the prize, big market, segmented into a number of different environments.
Yeah.
where players may just focus in their individual segment, or, and just for example, Barclays would play in all of those segments across retail, affluent, high net worth. They have a private bank. So there'll be some firms that actually do have disciplines across all of that environment.
Okay. Well, we're going to drill down later on to some of the issues around the corporate developments in 2023 and into 2024. But in the meantime, one of the things that I find fascinating are, well, we mentioned the three-letter acronym already, DFM, but there are a number of structures, corporate structures that our investment managers need to understand. And you know, our fund manager clients in the US, for example, probably need to get better understanding. Can we just touch on the differences between, you know, a DFM, a fund of funds, an MPS, a managed portfolio service, a centralized investment proposition, all those different acronyms and what they mean? I don't want to go too detailed, but maybe just a high level understanding.
Yeah, no, I think it's a very good point. And I have to say, I do offer some training to certain environments, and I do have an acronyms quiz. And there's over 100 3- or 4-letter acronyms that our investment management environment does. So I always try not to talk there. But DFMs, all acronyms, discretionary fund managers. So basically, what is a DFM? Well, it is a firm that is looking after normally private clients, individuals. That does normally move into trusts and sometimes charities, but it's actually acting on discretion. So the client signs a discretionary mandate, the same to a DFM, a wealth manager, within the risk profile that I've worked out, or you've worked out for me. I will give you this amount of money for you to invest on a discretionary basis. So rather than advisory, where you would discuss it and you would agree it, with discretion, you are setting up a sort of a set of what I would call risk adjusted environments, whether they're models or whether they're an investment profile, where you will match that client's risk appetite to a set of profiles. So DFMs are acting with discretion. They do offer advice that is now coming back into the environment here in the UK. Very strong in other places like Switzerland, which is quite similar to the UK, where advice has always been very, very strong. Execution only, but to a lesser extent. Execution only is now more for the old stockbrokers and on platform, i.e. Hargreaves, etc. So within a DFM, and I'm going to use Brooks Macdonald as just as an example. So Brooks Macdonald is around 17 billion sterling of AUM. And they have a set of investors, individuals, trusts, etc., etc. For that, they have a huge amount invested in their managed portfolio service. I think it's 20%. So over time, they've set up a managed portfolio service. And what is an MPS, a managed portfolio service? It's a set of models, and there's normally between 1 to 5, cautious all the way through to perhaps aggressive. If that's the term, where they will decide how they're going to construct the model through a set of investments, through a sort of strategic asset allocation lens. And then these will be put onto a platform, Novia, Transact, all big platforms. And IFAs, rather than construct their own model portfolios, can go in and buy that model portfolio that relates to the clients that they're looking after. So this is huge business, and it seems to be growing apace.
So and can you just touch on why that developed? Because if my memory serves me right, I mean, the Retail Distribution Review, which came out in 2013, I think it was.
2012, yeah.
2012-13. That seemed to accelerate this growth. What was behind that?
I guess what it was, well, the first thing with Retail Distribution Review was one of the principles was to have a more educated advisor. So the sort of the CFA, the type of regulatory regime, did take out quite a few more mature gentlemen and ladies in that environment, where a lot of them sold their firms, they retired. So we've seen the advisor market, the IFA market shrink. 2 reasons: people retire, sell their business, and then the consolidators, the networks that are buying up individual IFAs and becoming a consolidator. So first thing I say is education and knowledge around how to construct portfolios. The second bit, I guess, is cost. And do you really want to be a master of everything in strategic asset allocation if you're an IFA?
Yeah.
If you're an IFA, you should be advising clients on their sort of tax, on their sort of goals-based horizons, whether they're looking to save daughter's marriage or whatever, pension planning. As a result of that financial planning, you then say, right, for your horizon X, we have a 30-year time frame, and we recommend that this is the type of investment portfolio that would match those needs. May just be one goal, or there may be more. So looking at that, I think it's an area of expertise where if you can get it at a reasonable price, and some of these MPSs are 60 bips on a platform, rather than you having to look around and then almost judge that you have done everything under the Consumer Duty Act that we've got now to get fair value and to get expertise for your client, why not look to a Big House and Brooks Macdonald's one, Quilter, RBC Brewin Dolphin? I think there's 64 DFMs that are offering MPS, down to Tatton and other people. So why wouldn't you say, well, why don't we use an expert, someone that's looking at it all the time from a strategic asset allocation, a tactical asset allocation perspective, rebalancing when necessary because they have the expertise, and we will put our clients into a range of those solutions.
And I guess you're taking risk off the table. If you're the IFA, you're taking risk off the table because you're not having to make those decisions.
That risk, absolutely.
And I guess you could have some economies of scale. You can have access. I mean, if you had to recruit a person or a team to do that for you, the cost would be quite significant, I would imagine. Therefore, outsourcing that part makes more sense. As you say, an IFA wants to focus on tax planning, estate planning, and so on, rather than dealing with the fund management side. But putting those funds onto an MPS, it begs the next question, really, which is the plumbing. The fact that you've got to go onto a platform for starters. Are there other aspects for a fund manager, for example, who needs to get his fund onto a platform in order for it to be used by an MPS? What's the thinking around there? What's your thoughts on that?
So basically, I mean, that's something we did a round table on last year, and we did issue a white paper on MPS onto platforms. So if anyone's interested, I can always send them a copy. So if you think about the construction of the MPS, in some cases it will be a fund-of-fund approach. They will get that sort of exposure to certain geographies, to certain asset classes through just funds, or other people will invest direct into equities and bonds, or there's a mixture of each. So first of all, it's for the DFM to construct its own MPSs into its risk-based environments, and what is the environment there. So some will use funds, some will use direct, some use a mixture. That's their problem. So once the DFM has constructed it, his next problem is, right, what platforms do I need to get it on? And as we know, there's 20 platforms. They all have different procedures. They all have different policies. They all have different environments where you can have that share class, but we don't have that one. So what we see with the plumbing, if we want to call that, is mainly on the DFM getting their MPS onto all of these disparate platforms. That's the challenge. And it seems to be, whether it's the platform, it's technology, or it's processes, i.e., yes, we can cope with that share class, but we can't with that, and it will take us another 3 months to open it up. That seems to be where the logjam is. It's between platforms, technology, and the DFM. The IFA, from what we hear, just goes, well, as long as I can buy it, I don't care. As long as I can go on and I buy, provider XYZ's cautious or balanced MPS, then I'm not too worried. But there is very much a disconnect between what I can see in the platforms and then the people that are actually putting together the propositions and the mechanics of them getting onto the platforms. That's where the challenge is. So the fund manager, if you think about it, he's a manufacturer. He's manufacturing funds. He's then looking to distribute that out to wealth managers who'll buy. For them, technically, it shouldn't matter as long as they got the right share classes and right pricing. It's the responsibility of the DFM to construct each of their MPSs with whatever sort of funds, securities, etc., that they feel meets the asset allocation.
Yeah, the platforms. Yeah, I mean, it's been an interesting development. I mean, when the first platform came out in what, 96, I think it was,
Yeah.
something like that. Co-funds, one of them, Fidelity Fund Network were the two that first launched. And at that time, you could get a fund on there. You literally wrote to them, said, or emailed them, said, hey, we've got a fund on, not a problem.
Yeah.
And you literally, it was fine. Today, you have this bit of a chicken and egg. And we certainly find that with some of the boutique managers that we work with, where they go, well, we need to be on this particular platform.
Yes.
And they go, well, unfortunately, you've got a problem because we can't put you on because we need to see demand. We can't get demand unless you're on the platform. And you have this constant debate with platforms about this. Now, thankfully, from a GemCap point of view, we have the agreement, and we have the agreements at the company level, not at the fund level. So it's much easier. And I understand why the platforms do push back, because they're going, well, for us to review a fund and the legal agreements, the SLAs, etc., is in time and cost. So therefore, we need to see some demand, otherwise we're not going to get the money back on it. So I do understand that, and that's why we've made the agreements at the company level. So it makes life a little bit easier. But it does become a challenge, I think, for boutique managers who are dealing with wealth managers, and the wealth managers are saying we need other platform, and then so the wealth manager then goes, sorry, the wealth manager will try and help. I have to say, most people like Brooks are very good. They'll turn around and say, yeah, we like this fund. We'll talk to the platforms. But it becomes challenging with boutique managing approaches, because the platforms go, who are you? What's your deal?
Well, absolutely. It is a scale game. It
is. But you mentioned 20 platforms there. I hadn't realised it was 20. I know we probably deal with all of them. Is there some consolidation due? I think.
Well, there is, and there is some movement there. I mean, if you think about it, you've got all the platforms there. There is, obviously there is amalgamation. James Hay, etc. FNZ's powering 60 or 70% of the platforms. An interesting move that we saw, I think it was last month, where Nucleus, as a platform, acquired Third Financial, which is very much a wealth management outsourcing business. But it also gives firms the ability to white label their own platform. And that's what we've seen as well with Seckle coming into the market.
Yeah, David Ferguson's business.
And Third Financial, where we're seeing, is this the sort of the way of travel, is to have an advisor to have its own white labeled platform. Right. But I think the jury's out there. We've seen that traction. And then you've seen, well, is it the right way to do it? There seems to be two camps of thought. But it was interesting that Nucleus, which has been a traditional platform, is buying a wealth management outsourcing business, Third Financial, that also has a software arm as well. So Third Financial, you could think of being like a Pershing, doing a Model B environment. Right. So I think we're going to see consolidation and perhaps a different lens into what is wealth and what do they need. So I think that platform market has been consolidating. But then again, you get new entrants coming in as well. So it's quite cyclical.
Yeah. Well, I think this is time to just talk about the developments overall in the wealth management space, because it didn't seem, a week goes by last year when there was some activity in the market, and the wealth management space in particular seems to have been very active with a lot of consolidation. We've seen that again at the beginning of this year, just a couple of weeks ago, the announcement of London Capital merging with Waverton. What do you put behind that? Why the wealth management space? And also, let's just touch, if we may, on the ones that work from your point of view and the ones that don't work, and maybe what needs to be done. I mean, I've done a lot of mergers and acquisitions in my own career, and I've got a particularly strong view, but I'm interested in your thoughts. I mean, what's going on in the industry at this moment in time then?
Yeah, it's a fascinating thing. I mean, obviously trying to keep up with wealth management environments, to me, is a full-time job. It's like painting the Forth Bridge. So the first part of my day over breakfast and cornflakes is to read all of the newswires in wealth. And you're absolutely right, Stuart. I mean, consolidation has been going on apace. I mean, we've had some mega deals with, the Investec and Rathbone merger that formed, 100 billion plus wealth management business. It is massive. Charles Stanley being taken out by Raymond James, RBC Brewing Dolphin. So we've had these, and you mentioned one of the last ones that I did update a slide in a presentation last week where I had to put it through. But then on, I think it was Thursday, Mattioli Woods being bought by private equity, Pollen Street Capital, is taking Mattioli Woods private. I think it's a 430 odd million deal. So again, we're seeing more activity all the time. The latest rumor, which we've seen, is obviously SocGen is looking allegedly to sell Kleinwort Hambros, one of those other last names of merchant banking and wealth management is up for sale. And you've got, and allegedly the rumor is you've got Barclays, Lloyds, Raymond James and Rathbones looking at taking out, and I think it's about 12 billion assets under management, Kleinwort Hambros. So trying to keep up with it is huge. Rationale behind it, I think it comes back to what I started with. It's quite a large market. There is lots of assets there. Can a larger organization, when it takes a private equity injection, be more effective than being on its own? I think the answer is, if it's done well, possibly yes.
Yeah.
Going back to your point, some of the mergers we've seen over the years have worked very, very well. I've mentioned, because obviously I was at Schroders for many, many years. The Schroders and Cazenove merger, in my opinion, worked really, really well. And a lot of that's to do with culture.
Yeah.
Are you culturally aligned? We're a people business, and wealth management even more so, because we look after individuals. So you see some that work well, and you see some that don't work so well. I'm not going to mention which ones, but we also have this piece of the providers, whether that's providers such as yourselves or vendors, IT vendors, software providers, custodians. As we see a more sort of active M&A market, we have winners and losers, because normally the people that are acquiring will go, well, actually, you're going to come onto our platform, you're going to take our providers. So we're also seeing in that market some winners and losers, which through no fault of your own, you could lose a large client, through no service issues, just because you were on the wrong side of the deal.
Yeah.
So I think what we will see is more consolidation. Private equity, as we all know, was very prevalent 22, 23. Interest rate cycles, perhaps sort of, I guess they said, well, we'll stand back and look at how interest rates are going to go. But didn't stop Mattioli Woods getting taken private last week. And we're going to see that continue without a shadow of a doubt. Yeah,
it's interesting you touch on the Rathbones of this world, just as an example. Obviously, their assets have gone skyward, and which is great news for them. It actually makes a problem for investment managers, doesn't it? Because of course, the size of the assets that they're running means that the size of the funds that they can buy also have to be high. So they can't be backing a 25 or 50 million pound fund. They've got to be buying a 250 million pound fund. I mean, do you see other challenges for investment managers dealing with wealth managers as this consolidation continues?
I think you hit the nail on the head. It's size and scale. The bigger you are, the more funds you're going to put through when you look at how you're going to invest in individual funds. I think the other one is that wealth managers also, apart from mutual funds, invest a lot in investment trusts.
Yeah.
They get a lot of exposure, certainly on the private market side and other environments where it's difficult to do it direct. You suddenly find, and I think it was some of the private markets investment trusts are now being saturated with wealth managers buying in size.
Yeah.
So that causes problems as well. So supply and demand, as the big get bigger, is going to be a challenge.
Yeah, I think so. Let's wrap up on this now. Just like I said before, 23 was a busy year. 24 has started off pretty madly already. What do you see for the rest of this year? I know you haven't got a crystal ball there. You're not Gypsy Rose Lee or anything, but how do you see the market developing in the wealth management space this year? We won't hold you to account if you get it wrong, by the way.
Yeah, exactly. So this comes with a big caveat. No. And I think sitting back, and that's something that obviously we do towards the end of the year and look forward and what we've done there, it's going to be a number of themes. So first of all, we've talked about consolidation. We think that will continue. I think regulatory, we're still seeing the sort of the environment where consumer duty came into effect 31 July last year. We're now seeing some of the issues that are coming out of that. So regulatory strata. We'd have seen, you know, St James's Place, you know, the largest franchise of independent advice. Yeah, putting aside, I think they've put aside £426 million for redress.
Yeah.
Their share price has gone down by 30%, which has had a knock-on effect to other quoted asset managers, not just wealth managers.
Yeah.
So I think that regulatory environment's always going to be there. And as we know, the FCA issued the Dear CEO letter back end of last year, saying, you know, we will be making sure that you're adhering to all of the Consumer Duty Act.
Yeah.
But having words in it like, yes, intrusive visits, unannounced visits. I mean, this was big stick stuff.
Yeah.
And so that was the first bit. Then obviously they followed up with this 20 advice firms, the investigation, and SJP was one. So I think there's going to be more focus on that Consumer Duty Act. Not the fact it was interacted last year, it's how did you do it and what have you still got to do? Yeah. So we think there's going to be some redress around that. And that does lead to how will fund managers look to improve margins? Because within wealth management companies, sometimes their cost income ratios are most probably higher than they would like.
Yeah.
And it's around investment in a lot of things. One thing I think that the wealth management market has been quite slow to adapt is new technology. There is still a lot of legacy platforms underpinning the wealth management industry, which is a problem. Because when you think about it, you know, what's one of the main trends they want to do is they want to be digital. They don't know what digital is in some cases.
Right.
As one wealth manager said to me, it's, well, we don't send paper reports anymore, we do PDFs. Really good. I'm looking here now to digital 3.0 and 4.0. That's not digital. Yeah. So again, how do they look at the technology? Do they replace, if you replace a legacy platform, that's like open heart surgery. Yeah. You don't want to do it too often and it comes with risk. Yeah. So is it more of an ecosystem of digital toolkit that you can put around your sort of solution? And that comes down to, I guess, enhancing the client experience. Because whichever way wealth managers look at it, they should be looking at what the client expects and what the client needs. And you know, we see this, it's always a trend, intergenerational shift of wealth. When do the younger generation, well, that younger generation is mostly 50, but how do the younger generation, whether they are inheriting wealth or they're entrepreneurs that have made wealth, you know, it's obvious that they perhaps are going to look for a different type of service than perhaps their parents and their grandparents. Yeah. So I think there's all around technology. And then the obvious one that's come out that's the hot topic of this week or this month is AI. Yes. How do we look at artificial intelligence to help us run money? And that's a whole different subject for an interview. Because, you know, I go through these things, you know, we did, first of all, we did ESG. That was the hot topic. So that is still a topic with sustainability, but it seemed to go up the mountain, plateau, and then become less of an issue. It's still there, don't get me wrong. Yeah. Crypto, Bitcoin, that suddenly raised its head. And we did a lot of thought leadership on crypto and digital assets, which was fascinating. That seems to have gone up, but Bitcoin seems to be continuing. So that's around there. And at the moment, it's on AI. How can we use AI effectively to make us sort of more scalable, to use some of the toolkits that are coming? And as you and I mean, AI depends what it is, but things like RPA and machine learning have been around for years. Yeah. We've been using them in the back office for reconciliations, etc. But when you say AI, everyone goes, ChatGPT, I've got that. Yeah. So I think they're also now going to struggle around how do we put policies and ethics around how we use AI. So I think there's a number of things there. Another thing that I get involved in, and I do a lot of, is the evaluation of a wealth manager's target operating model. Right. How is it going to evolve from that sort of potential old legacy stack? Years ago, I was talking to some very nice CEOs of private banks, and I was talking about cloud computing and cloud, and they were looking out the window up to the sky. Now, what we're seeing is the adoption of cloud technology is almost de facto.
Yeah.
People are now looking at sort of software as a service, managed services. And what we are seeing is very much a move to perhaps component-based outsourcing. As you will know, in the institutional world, Stuart, outsourcing to my old shop, I worked at State Street and Bank of New York, it's been going on for years.
Yeah.
Wealth managers have tended to be perhaps at the back end of that tanker. They don't turn as fast, but we are seeing some deals. And we talked about Brooks, public knowledge, Brooks outsourced to SS&C.
Yeah.
So, that was quite a big outsourcing in wealth, 17 billion, 70 staff, 2-pid over to SS&C,
Yeah.
Waverton to SEI. And there is another deal that's coming that is in the market, which will go to one of the outsourced providers.
Right.
So we see that wealth managers perhaps need to stand back and evaluate their target operating model. What do they do well? Well, if you're a wealth manager, what's important to you? Brand, identity. Is that something we're doing well that would entice clients to come to us rather than go down the street? Our digital environment, is our technology good so that clients want to come? Is our investment performance good? Do we select the right assets?
Mm-hmm.
Can we give access to private markets? That's something that they all want to do. It's not how good is their back and middle office.
No.
So my view is that we will see more component-based outsourcing. Gone are the days of you take everything. But what do we do well versus what does other people do well? And we've touched on front office. Why would I want to have all of these people looking at portfolio construction when I can outsource to someone that perhaps does it better?
Yeah,
and I think that's across front, middle, and back office is that we'll see this component-based environment. So target operating model, I think, will also be something that comes through.
Sounds like it's going to be a busy year for you, Stephen.
It's a busy year so far.
It's going to go far. Well, it's been great to catch up. Thank you so much for your time today, Stephen. We look forward to maybe you could come and join us again later on in the year and give us an update. But for now, I'd like to say
crystal ball was right.
Exactly. Thank you for now. All the best.
Thanks for your time. See you later.
Bye-bye.